Welcome to Market Watch. Today we are looking at the growing recession risk around the world as markets and investors digest where interest rates are going. With me, I have PiFund's CEO and founder, Mike Taylor. Hi, Mike.
Hi, Liam.
Hasn't got any less worrying out there in terms of the real world indicators for the economy. What have you seen in the past few weeks around the market sentiment?
Well, definitely recession risks continue to grow. I guess they've been building throughout the year. What's perhaps been surprising about it is that the consumer has been as strong as they have been. So it has taken a significant number of interest rate hikes to actually put the brakes on economies, both here in New Zealand and around the globe. And even as we stand today, there are still patches of the economy and consumer spending that are resilient, which is an encouraging higher interest rates going into the end of the year. However, I think that we all need to step back a little bit and say that when you raise rates, it does take about 6 months to have an impact on the real economy. So the rates we see today were actually the rates the economy had 6 months ago. So we won't really know how the economy is doing until probably March next year. So, but at this point, it does look like things are slowing down, which is indicating we are heading to recession at the beginning of next year.
In that sort of vacuum, before we find out, that the really hard data, it does seem like markets the sentiment is swinging backwards and forwards pretty dramatically. Is that? I mean, have you noticed that those sort of big highs and lows?
Yeah, sentiment is moving around quite a bit, and I think sentiment is moving more based on outlook from the Federal Reserve than it is based on economic activity. So, if we didn't have a high inflation problem, economists, investors would be really focusing on corporate earnings. But because the whole issue here has really been about inflation and what the Fed's doing about that and how they're pushing interest rates, much more of the focus this time around has really been on where inflation's going and then what are the Fed doing with rates. So although the market's kind of got one eye on earnings in next year, it's much more focused on what the Fed's doing. So if we can get a sort of an outcome on has the Fed done enough, they're going to start to pause or slow down, even though earnings might still look quite negative next year, that might be enough for the market to sort of breathe a sigh of relief that actually, all right, the tightening cycle's over, we can relax a bit. Because at the moment, there's just this uncertainty is that how high will rates go?
Yeah, we still haven't seen absolute evidence that it's peaked, that inflation has peaked. And I guess from an investor point of view, it's really starting to stack up as a pretty tough year. When you look at 2022 so far, how does it sit with the sort of history of market performance?
So looking historically, if we look at just a bond portfolio, it's one of the worst years on record. In fact, I think it is the worst year on record. So if you're a bond investor, it's been disastrous. In terms of equities, year to date so far, it's also probably in one of the top five in terms of, or bottom five in terms of performance. So it's pretty bad. The reason I suppose why it hasn't felt so dramatic is that we haven't really had a crash or anything that sort of grabs headlines as you might see in the past, like 1987 or Lehman's collapse in 2008. So what we've seen throughout the year is that everyone's been well aware of what the problem is that, we've been through a pandemic, we've had high inflation. And so investors have adjusted to that gradually throughout the year and being in almost sort of a relatively calm way. There hasn't been too much panic within the markets.
Sure. And so when we look at those returns on yields on bonds, and is that a reflection of the fact that we are seeing probably the most dramatic and sort of fastest acceleration of central bank rate hikes, I think probably in living memory?
Yeah, absolutely. This is the fastest acceleration we've seen. And we don't know what the impact of that's going to be in 6 to 12 months. So we can only surmise. And the best guess is to say that the economy will slow quite markedly in 2023.
But just to sort of reiterate, it may be that, by the time that real world economy is slowing, markets have been reassured that we've seen inflation peak and they may be looking out the other side of that.
Yeah, I think this cycle, markets or investors are much more focused on inflation and rates than on the corporate earnings. I mean, ultimately, it's corporate earnings that drive stock prices, but investors are probably willing to give the market some rope here, and they'll look through the earnings because the earnings will be falling as a result of higher inflation.
Yeah, but as far as that peak goes, it has been a pretty tough thing to watch. Just the latest figures out of Europe, for example, still seeing inflation hit new highs. It doesn't seem to be coming off anywhere, with any certainty or anywhere nearly as fast as we would have hoped.
Well, probably US inflation will be the one to fall first, because with such a strong dollar, they've been able to sort of export their inflation to other countries. Europe, of course, has been the epicenter of the energy crisis, and so much of their inflation is down to energy. And actually, there is quite a variance within the Eurozone. You have some countries like Estonia with inflation at 22%, and other ones like France running about a 7%. So, but overall for the Eurozone, it is the October reading was another high of 10.7%.
And look, speaking of Europe, obviously we've seen some incredible turmoil on British financial markets with British bonds, and it's sort of all tied into the political instability they've had.
What's actually been really interesting, I think, is that how market participants or bond investors have almost been able to force a change of government here. So the proposals that came out from Liz Truss's government of cutting taxes and more spending was, quite vehemently rejected by the bond or the gilt market, as it's referred to in the UK, pushing their long-term rates up from around about 3.6 to 5% in a matter of days. And so they were forced initially to sort of pull back some of those, but the market was still not satisfied, and eventually she had to resign.
Yeah, I mean, I guess it suggests that these are enormous markets, and they have a lot of power, and that there is a prescription, an economic prescription that really modern governments can't stray too far from.
That's right. Otherwise, you'll end up with your debt priced like an emerging market.
Well, it seems to have stabilized a little bit in the UK, obviously with the the new Prime Minister. I guess we are still left really just waiting and watching that US data from a New Zealand point of view to find that peak.
Yeah, I mean, US inflation at the moment hasn't had a higher print since June of this year, so it's sort of stabilized around that level. And so really, yeah, we are looking for lower prints than CPI, but don't expect the Fed to just immediately pause or cut. They have indicated, the target is to get back to 2%. So in the absence of a financial shock, I would expect them to sort of reach their point where they're comfortable to wait, and then hold rates there until such time as inflation is really falling through the floor.
Okay, that's great. Thanks, Mike. We'll leave it there, and hopefully by the time we talk next, we may have seen some more evidence that we are through that peak.
Hopefully.
Cheers.